Welcome back. Futures are mixed this morning. Take a look. Dow Industrial's up 70 points right now, surging further into record territory. But the Nasdaq is lower right now. It is down 282. Yesterday, similar situation. The Dow up nearly 900 points, rallying to fresh all-time highs as the Nasdaq dropped and investors turned from chip stocks and into financials and healthcare. United Healthcare led the Dow, up better than 5% on the session. JP Morgan and Walmart also adding to the gains. That really was the strength in the Dow Industrials. JP Morgan up 3 1/3%. The rotation away from AI and tech sparked by Broadcom's sell-off yesterday. The company posted a revenue miss, sparking the stock to drop better than 12% on the session. And the sell-off continues this morning, down another 1.5% right now on Broadcom. Joining me now is Federated Hermes Chief Investment Officer of Equities, Stephen Auth. Stephen, good to see you. Is this the right move, moving away from some of these high-flying tech names after the Broadcom miss and start broadening out the portfolio?
Well, yeah, Maria, as you know, we've been calling for a broadening out. And you know, I keep telling people we've had a broadening out already. I mean, even before the sell-off yesterday, small-cap stocks were up 18%. Large-cap growth stocks were up 7 or 8%. It's just that off the lows back in March, the move out of the lows was led by the tech and the AI stocks, and people were very focused on that. The setup for Broadcom, as you know, was really difficult. I mean, the stock had been up like almost 50% off the lows. So it's very natural to have a little bit of a pullback here, and rotation is healthy in the market. We've been having a rotational market really for the last 6 months. And we continue to think we're going to see one. That's much better than a big, market-wide sell-off. So it's another way for the market to keep adjusting itself and stay healthy. It's all been fueled by earnings. I mean, earnings are just exploding.
Our earnings have been very strong. Do you see a particularly strong area of earnings that you want to look at in terms of where the growth is?
It's pretty broad, Maria. It's in the commodities and energy space, but it's obviously in the tech space. Free cash flow is pretty high there. And we think some of these other areas in the market that are underappreciated are going to start to see some pretty good growth too, like regional banks, once the Fed resumes its rate cutting cycle, which we expect it'll do, probably next year. But the year-over-year inflation numbers next year, which is what Kevin Warsh is going to be looking at, are going to be pretty good. A lot of these high prices in energy, food, commodity, beef, a lot of these things are going to be coming off next year. So we could find ourselves in an environment where the Fed's cutting again.
So what do you make of this concern around AI? I mean, Anthropic this morning, a piece in the Journal, is urging a global pause on AI development. Anthropic is warning that models are nearing the ability to improve themselves without human intervention. The Claude maker filed for its IPO earlier this week, of course, with a valuation of nearly $1 trillion. The company says the high cost of developing AI models is driving firms like Anthropic to look to the public markets to raise capital. The company filed ahead of its competitor, OpenAI. And, of course, as you know, SpaceX is planning its public debut, approaching nearly a $2 trillion valuation. The S&P 500 reportedly denying these mega IPOs early entry into the benchmark index. Goldman Sachs also reportedly expecting the rocket maker to generate $322 billion in revenue in its AI division by 2030. That's a huge change from the $3.2 billion seen in 2025, Stephen. So what's your assessment of these mega IPOs and the concerns around AI, given Anthropic has been pretty vocal? It wants to slow down this development globally.
Look, Maria, this is a technological revolution, as you've been reporting for the last several months, and it's going to continue. It's a new industrial revolution here. There will be problems with it, but net, it is now pervading the entire economy. And along with all the supply side reforms that President Trump and his administration have put through, we're just seeing an explosion in earnings that are likely to go on for quite a bit of time. We just raised our numbers for 2028, which is 3 years out, but it's kind of how we set our longer term targets. We bumped them up again to 450, and it's largely because margins are continuing to expand, partly because of AI. So, yeah, there will be a little bit of short-term disruption for sure when they launch these IPOs. But remember, the float on these IPOs is a lot less than the implied market cap of them. So the market should be able to absorb them. It may cause a little more rotation, as I think, as I said earlier, it would be healthy. But, we think the market's going to probably keep marching forward over the next 2 or 3 years. It looks like a pretty good bull market setup for us. And this is nothing like the 90s when you had all these stocks going up on no earnings, just clicks, on a mouse. So it's quite a different.
There was the thinking was that given these huge IPOs, investors are going to have to sell something to buy the IPOs. So maybe they're selling AI stocks now so that they could raise money for these IPOs. Do you think that's what's going on here?
There could be a little bit of that, Maria, but maybe they're selling cash. They've got $7 trillion, or maybe they're selling bonds. Bonds, people are talking about stocks having a problem with bond rates at 4.5% or 5%. I would say bonds kind of are having a problem with returns on equities. And, bond investors are starting to demand a higher return on their capital, given the returns available in this earnings-driven, supply-side-driven economic growth, profit growth environment. Bonds don't participate in all that. So, yeah, a little bit of money will come out of equities, the existing set of stocks, to fund what looks like maybe $400 or $500 billion of new capital going into a variety of IPOs. But the capital markets are quite a bit larger than that, and there's still a lot of cash on the sidelines that, sold off down at the lows as usual back in March and is trying to get back into the market. So I think it'll keep the corrections short and shallow.
Yeah, well, we got that $8 trillion on the sidelines. You're right. Incredible numbers. Stephen, always a pleasure to check in. Thanks so much.
Thank you, Maria.
All right, Stephen Auth joining us. Stay with us. We'll be right back.